Hey everybody, this is Rich Hayden with Hayden Home Mortgage coming to you with the October edition of Market Perspectives. And I want to share some information I talked about in a recent newsletter. And I think you'll find this valuable because right now, we've got the Federal Reserve raising interest rates for the fifth time this year. And I'm going to go ahead and share that with you. We can just see, this year we see these step ups. This is the Fed raising in March, raising again in May, raising again in June, here in July, and then most recently just last week in September. And every time that happens, the news just blows up and tells us all that, the sky is falling. And the one thing we know when this happens is that things get more expensive. But which things get more expensive? Well, pretty specifically, your credit cards and your consumer loans, which would be those which are tied to just an unsecured liability, a consumer lending company. Car loans get more expensive. And then, of course, the inflation that hits everything at the grocery store, the gas pump, and so on. So these phenomena are not new. I'm showing here on a chart from the Federal Reserve in St. Louis, the Fed Bank in St. Louis, showing you what the prime rate looks like over the course of the last, 60 years or so, 62, 63 years. And you can see, the prime rate really hit its worst number back in December of 1980. And we were up at 21.5% for a prime rate. Back then, mortgages sat at around 18%. And so what we do know is that every time we get one of these high numbers, we trigger a recession. And so you see here in gray in each one of these sections, that's where rates got a bit too high, inflation was a little bit too hot, and a recession followed. And then what happened is rates came down. So we know that as we head into a recessionary period here, and we are technically into one, rates are up right now, but we know that they're going to come down. And then there's a natural question of, well, what happens with home equity? Well, we can also look at these recessionary periods and see every time, with the exception of the Great Recession from 2008 to 2009, we did have a decline in values there, but we had recession 2020, recession 2008, we had home values increasing through the 2001 recession around 9/11. In the early 90s, we had a little bit of a dip. Things went better, right? We can look back further and further and further if we'd like to. This is as far as the data goes back. Try to hit 1990 and see what happens. But that's the longest we've got for the Case-Shiller Index, which is actually the best data set for figuring out home values over time. So we do know that home values, while we may soften a little bit here, will either remain stable, or once we get through this recessionary period, you see a little tick down here, it's normal, but we should see values stay about where they are or increase because we just don't have a lot of inventory. So what I talked about in this newsletter is, everybody's got a great mortgage right now. I mean, pretend for a second you refinance back in 2020 or 2021, right? $455,000 loan at 2.75% on a 30-year fixed rate mortgage. Your principal and interest payment on that guy is $1,857 a month. You'd almost be bonkers to refinance and pull consumer debt in. And why am I talking about consumer debt? Well, right now we're seeing average credit card rates tick up into the 20s, right? And depending upon the type of credit card you have, you could be up into the 25s, for a store card, or potentially higher depending upon your particular credit score or your spending habits. And as the Fed increases rates, credit card rates go up. And what we see in these recessionary periods is that people take on more and more consumer debt. And when they do that, things tend to get a little bit out of control. And so one of the things we're talking about right now, historically, when rates are lower, you can refinance and pull that credit card debt in and kind of fence it all in on an attractive interest rate. Well, with rates up where they are right now, let's say we've got a family and they've got their current loan balance on that loan I just showed is down to $434. They got that 2.75% interest rate, but they've got these debts that are kind of hanging over them, and those things are sitting, another $1,100, $1,200 a month. But they got a ton of equity in the house, right? So what can that family do? Well, one of the things that they can do is take a look at either a consolidation loan where they pull everything onto a new loan, and right now that'd be at about 6.927%. Now they would improve their monthly cash flow because they'd be putting everything onto one loan vehicle, but you'd be up at almost 7%. And you'd be putting that big chunk of money that you have at 2.75 at a higher rate. That might not make the most sense. So what we're looking at is leave that thing alone and potentially consider a home equity line of credit or a home equity loan, two different things. But in this case, this family's home was worth $775. They got a $435 current balance. And so that means they could, reasonably take up to $262,000 for debt consolidation. In their case, they've got about $60,000 worth of debt. So I wouldn't say take 260. Take $60,000 and fence that money in. What do I mean by fence it in? Well, you put a fence around it and you say, now the credit cards, the car loans, the consumer loans that I have that average in at about 18%. Well, if I put a fence on those and put them on what amounts to a 20-year note with an interest rate of 8.49%, I'm going to have a reasonable repayment of about $755 a month. So I'm $400 a month in the green. I can pay more on this. It's not revolving debt. It's not revolving interest. It's simple interest. And that is going to provide relief for the homeowner. It's going to provide a clear path to full repayment. And it's going to eliminate the credit card debt so that this family can get on their way to a better financial plan. This isn't for everyone, and it's not the only way to address consumer debt. But it is one way, and it's something that folks with equity in their homes ought to consider as a financial tool. Every tool has an upside and a downside. If you'd like to have a conversation about that, hit me up. I'm at 703-957-0790. Again, this is Rich Hayden with Hayden Home Mortgage. Take care.